Marvin, I want to start us off in China. You heard Sherry there mentioning about moves to protect the weakness in the yuan. But if we take a look at this chart on the Bloomberg, we can also see that there's been a record streak of net selling by foreign investors over the stock connect. Would you be recommending investors to join that exodus?
Yeah, I mean, we're still concerned about the policy response that the administration there can actually implement on an ongoing basis. So, yeah, I mean, I think there's still a lot of wood to chop before we get comfortable that it's time to think about picking the bottom here. A lot of questions about the efficacy of what they can do, and really the environment now with regard to demand as well as the property sector kind of keeps us quite defensive on the region.
When we've been in situations like this before, it usually means the stage is set for an entrance by the national team to buy up stocks, put a floor under some of the selling. But is there a risk there that it would just end up providing a more attractive exit point for investors? Is that something that you think we're likely to see?
Yeah, I think that's absolutely correct. I think it is a risk. I think some of the economic issues that, we've all been made aware of within a very, very short period of time are fairly significant. And you need to see kind of demand. And don't forget that we are kind of dealing with a lot of these concerns as you've got the global growth landscape really starting to slow down on top of it. So kind of that natural engine that often comes from the export side of things is nowhere near as robust, kind of thinking about this for the next several quarters as it potentially has been in the past.
And yet the U.S. continues to surprise to the upside when it comes to economic data, right? And really that leading to that volatility in the rates market. What is this telling you about whether policy expectations are being properly reflected?
Yeah, so I mean, this rate sell-off certainly has been quite drastic, quite violent over the course of the last few weeks. And in a lot of ways, it hasn't been one where the story around higher yields have kind of matched up. When we kind of look at policy expectations, they've gotten a little bit tighter, expecting less in terms of cuts looking into 2024 and maybe a little bit beyond that. But in terms of where the market thinks the Fed is going to reach terminal, that hasn't changed too much. And overall inflation expectations haven't really changed that much. This is, what we call a real yield-driven type of sell-off, which has a lot of implications in terms of just where overall yields are going to clear once we kind of get through this. But with a lot of the uncertainty that remains out there in terms of a post-pandemic environment, as well as whether or not those structural aspects that keep the U.S. economy afloat can continue going into next year, I think we'll cap rates somewhere around here. It's hard to try to catch that falling knife, if you will, but there are just a lot of stories that aren't matching up quite cleanly.